Hi everybody, I'm Steve McDonald and this is your Investors Daily Edge Weekend Wrap-Up. In focus today, the best way I've seen this week to make money, another view of the deleveraging that's going on in this country, investors fleeing the stock market, 3 indicators of a better stock market in the next 6 months, and of course the Slap in the Face Award. The best way to make money this week, it was described in a Wall Street Journal article Tuesday. The journal looked at companies that had PE ratios below 15, which is cheap when you look at where PEs have been, lots of cash, low debt, and big names only. It came up with 20 names of big, well-capitalized, low debt-to-asset ratio companies that are paying, just in dividends, 3.5% to as high as 6% plus. The best news is that these stocks are selling at 1970s earnings-adjusted prices, 1970 prices. Now, when you look at what cash and cash-like investments are paying, almost nothing. Treasury payouts are at all-time lows. 3.5 to over 6% just in dividends are huge, and they're based on very low PEs, so they have good growth potential from their current levels. Now, investors are fleeing. Sounds like a herd move, doesn't it? Fleeing the stock market for bond funds and treasuries, and I've talked about why this is financial suicide before. Now, that aside, they're missing one of the best opportunities we've seen in my adult life to lock in great blue-chip portfolio in a depressed environment at 1970s earnings-adjusted prices with great growth prospects as well. Follow the herd, and I know you'll be sorry. Look at the big names that have lots of cash on their balance sheets, low PEs, and a history of paying their dividends. This is what we do every month at Sound Profits. You really should take a look at this. It's a great newsletter. And this is exactly what we've been pushing, big names. We've been pushing this stuff all year. Collect the big dividends while you wait out this slow growth period we have right now. And if my gut is right, we'll see a nice move in the share prices in the next 6 months. Now, speaking of investors fleeing the stock market, the numbers continue to show a huge move to bond funds and emerging market funds. Now, they're going there for the perceived security and higher payouts, and they couldn't be more wrong. Emerging markets have always been and still are a high-risk investment. Yes, everything looks perfect now. They've had a couple of great years, but the folks were moving there because they think they're getting lower risk compared to the U.S. markets are very badly informed. The same is true for bond funds. Investors have been rushing into these. There's that herd sound again, rushing in, and they too have had a very bad future in store. $39 billion have come out of stock funds this year, and $49 billion have gone into bond funds. That's a lot of money. The high rates of return these funds flaunt to get you in there will be their undoing. But I've been pounding the table about that long enough. Never in my 25 years in the market have I seen a situation where the herd has gone that it has worked out. Never. In fact, in every case, it's turned into a disaster, and this one is going to be no different. If you want higher returns in the U.S. markets, emerging markets will probably deliver, but know the risk you are assuming to get it. It is substantially higher than the U.S. market risk that I'm talking about. And these bond funds that everybody's in love with right now are time bombs, and you're going to get caught in the blow-up, so be careful. Deleveraging. We hear a lot about how the U.S. consumer is deleveraging, especially when it comes to credit card debt. But here's something you haven't heard. Much of the decrease we've seen in credit card debt, according to a journal article, has not been the result of people paying them off. It is the credit card companies writing off bad debt. Significant higher write-offs since the credit crisis a few years ago. It appears debt levels are dropping for the highest cost consumer debt, credit cards, but the numbers tell a different story. The article called credit cards the new pawn shops because people are making the minimum payments on them just to keep them from being canceled and are viewing them as their last resort for money if all else fails. The new pawn shops. That's pretty sad. Here are 3 indicators of good news ahead for the stock market. As you probably know by now, I have a whole lot of indicators I use to judge the market. Notice I didn't say predict, bad word, predict, judge the market going out 6 months. Shipping, rail, ships, trucking, and air. FedEx this week, as I said on Tuesday, are a really good sign, but here's a very interesting international number. The CCFI, China Containerized Freight Index, that's goods shipped by ship, is up 53% year over year. But more importantly, it's up 5% over its 2008 peak and is only 1% below its 5-year peak. I like these numbers because it shows what it's doing relative to the really good times before the collapse of the world markets. Other good 6-month indicators. Johnson Controls just reported numbers. Johnson had very good numbers for the second quarter, and it's directly tied, not entirely, but very closely tied to the auto business. A big part of their revenues are tied to the auto part and supply business. Now, if JCI is doing well, that means the autos are doing well, and I like the looks of this one. Last, Eaton, not as well known in name as some, but a big player, and they're showing very good signs. This is an industrial equipment manufacturer, Key Industrial, and their earnings announcement this week was described by a journal editor as one of the best any company has had in recent years. They saw significant improved demand in parts for trucks. There's that shipping link again, trucks. Also hydraulics and electrical supplies. Now, these aren't parts that are used by the consumers, but industry, and if industries are ordering them, they must be putting them to use. Barring any unforeseen craziness by Iran or Korea, we could have a very nice second half in the U.S. equities. Not a smooth ride, but a good one. And now, I know you've been waiting for it, the Slap in the Face Award. This weekend, it goes to those members of Congress that can't seem to come up with anything new but new ways to spend our money. Take Harry Reid's new energy bill that he rolled out this week. Here was an opportunity to use his party's almost supermajority, which they don't seem to have any trouble putting together when they want to push a spending bill through, to push through something that could really do some good for this country, a real energy policy that could point us to lower oil imports and more alternative sources. And we really need this. But it didn't involve a new tax or spending, so it didn't warrant the attention the unquestioned backing health care and tax increases get. What we got was the same watered-down garbage we've seen for the past 30 years. I guess Obama's change doesn't include an energy plan. The press, of course, managed to miss this whole thing again. Another pass for the Democrats in Congress and the White House. We must have an energy plan, and it has to include more than Obama going down to look at the spill problems in the Gulf and slamming BP. The really bad news is the oil companies have such a stranglehold on Washington that it wasn't any different when the Republicans had control. November is coming, thank God. Have a great weekend for everybody here at IDE. I'm Steve McDonald. Thank you for being a part of us.